Well, welcome everyone, and thank you for joining us. Today's webinar is going to be led by James Turner, the CEO of Fifth Line, and we're joined by Adam Sanderson as well. He's a financial services consultant here at Fifth Line, specializes in FP&A, financial systems integration, forecasting. Again, thank you for joining us. If you have any questions during the presentation, please just add them to the chat, and we'll get to them at the end. But James, the floor is yours.
Thank you. Thanks for joining us, everyone. We want to put this together because over the past, 3-4 months, we've been seeing a lot more companies, that have a lot of questions essentially on, how to get ready to raise capital. There are some parallels between equity and debt, but given that we are debt focused in everything that we do, that'll be the focus of today's conversation. So we're going to start by introducing who we are, talk about the companies that we typically work with, to set a framework for how our information is presented. Afterward, as John said, we'll have some time for some questions and answers section, and hopefully we can get everything addressed for you. So you walk away from here feeling a little bit more educated. So starting with who we are. We're a financial services firm focused on growth stage companies. Our solutions range from financial operations to financial strategy. Think of controller and CFO type of work. And our core focus, honestly, is really in the venture debt raising for companies, primarily those in between major equity rounds. So typical client profile for us is a tech-enabled services business model. A lot of them are still cash burning in their growth mode as a result. They're just not a fit for anything from their local credit union to go into a big money center bank like JP Morgan, Wells Fargo, Bank of America. They're also honestly rarely a fit for some of the quote unquote traditional venture lenders out there, whether they be some of the venture lending banks or some of the big household funds that exist out there if you were to Google venture debt very quickly. Our clients tend to have a more creative situation that they need a specialized, a tailored solution for when it comes to the debt capital markets. So starting with what is venture debt? There are a couple different ways to think about it, honestly. In short, we just categorize it as debt financing for an often cash burning asset light business model that is not a fit for the traditional commercial lending paper. So it's really used for a number of different reasons. Think of it as, you don't have assets or cash flow, so you can't walk into your local bank for EBITDA based or cash flow lending type of profile. It's viewed as an alternative to equity financing. Most of our clients come to us with the same situations. Hey, we are looking at one of two routes. We are looking at an equity raise in the next 3 to 6 months, but if debt financing is an option, we prefer to go that non-dilutive route and push out that equity raise that much further to get a better valuation and minimize our dilution at that point. Most venture debt is structured as term loans or lines of credit. Common components do include interest rate and warrants. I'll go into more on the pricing afterward, but those are very key in most venture debt type of deals. Big thing that companies do tend to like, it's not a personal guarantee type of structure. It's structured on the business, the revenue model, the growth trajectory, similar underwriting as think of like a venture equity type of, like an equity type of investment, but they put their money out in the form of debt. So it's not like just looking at, your personal assets to, can you back up the loan? When to use it? There are a number of different use cases that make sense for debt. Incremental capital to accelerate growth. So, company is doing well, things are moving along. You're looking 6 months down the road and, you feel cash might get a little tighter than you prefer. It might be a good time to start exploring debt options. Take a look, see what options are out there. Does it make sense to continue on your current plan that might include cash burn and look at some debt to pad the balance sheet so you don't have to worry about it in 6 months' time? You can continue on your current path. Runway extension, that's the big one. That's a primary one. You're burning cash. You might run out of cash in 5, 6, 9, 12 months, whatever it might be. You're not quite sure if you're going to hit the milestone you want to get to before you go out for your next equity round. So, you take on some debt to extend that runway to, it could be a cash flow break even, it could be a revenue threshold, could be 1,000 different reasons. But really that's the most common use case we see for why companies in the market for debt financing. The more traditional model, which frankly is getting less common, especially in today's market from a transaction count standpoint, in conjunction with or following an equity round. So a company is raising call it a $10 million equity round. They want $5 to $7 million in debt financing to add on top. And then that's their runway until, same thing, cash flow break even, revenue milestone to raise a series B, C, D, and so on. That's a more traditional venture lending model. Though lenders do love seeing active equity investments, they are getting less common. So lenders really are focusing on the top two use cases the most. Asset purchases, equipment, buying another business. If you're a bigger business, it's still a buyer's market for you, even though if it's not a seller's market for you to go out for an exit transaction. Many bigger companies are talking to us and saying, hey, we're seeing a lot of good opportunities in the market. Can we finance the acquisition of a smaller competitor in the space? Short answer is yes. We look at it from a post-acquisition business profile. So long as that profile can support the existing debt, the transaction makes a lot of sense, and lenders do like that quite a bit. So understanding the difference between debt and equity. Yes, debt makes a lot of sense for a lot of use cases. Equity makes just as much sense for different use cases. So most of the time, equity is good for when you're pre-revenue or just going out to market. You're doing a few $100,000 or $500,000, whatever it might be in revenue. Debt can be really expensive very quickly for you, and it can be costly from a cash flow perspective because you do have to pay the debt back. Equity tends to make sense at that stage. Equity investors at that stage are very supportive, very understanding. They look 5, 7, sometimes even 10 years plus down the road. So they're much more patient capital. Turnaround situations. You lost a bunch of revenue. You are almost out of cash. You are going through a pivot or some type of turnaround situation. You're just struggling as a business. Equity is likely the better fit for you there. Distressed debt can be very expensive. It can be tricky, especially in today's market. So equity kind of white knight scenarios may actually make the most sense in certain situations like that. Strategic capital partners. So debt, what everyone loves about it is they are hands off. They're out of your hair. They let you run the business. As long as you pay your bills, they don't bother you. On the flip side, sometimes companies really do need that strategic partner. So you may look at an equity investment as dilutive, but at the same time, if it's someone that can get you into certain channels, help with certain product go-to-market strategies, help open up doors for you to grow that top-line revenue that much more, it actually might make more sense to go down the equity route. Now, when it comes to debt, pretty straightforward. 3 million plus in ARR, we found that balance of cost to cost benefit analysis actually benefits at that point when you're at the 3 million plus in ARR threshold. There are much more debt options out there that you can explore. Path to profitability within 24 months. To be honest, lenders generally like seeing 12 to 18 right now with the option to extend if the company generally performs. But you can't just be burning for the next 3 to 5 years uncontrollably. That's just a tough credit profile in today's market without the equity coming in, very constantly. And you're growing, even if it's slowly. Some of our slowest growing clients right now are about, I think it's 5% year over year growth, which is not great, but lenders understand sales cycles have lengthened. Customers are taking longer to make decisions. So you might need a little bit more time to hit that growth trajectory. But as long as you're generally growing and moving in the right direction, debt options do exist out there. So this is where I'm actually going to hand it over to Adam, who's going to walk you through from a CFO perspective, a financial operator perspective, who's been in businesses, what it looks like internally to start getting ready for a debt raise transaction.
Thank you, James, and thanks everyone. So you've made the decision to do a financial raise. What do you need to do? How do you prepare to do that? Well, with any financial capital raise, whether it's venture debt or any type of capital, you've got to make sure that your financial house is in order. And that means having financial experience at the helm, people that have been in place doing that prior. And as part of that, you want to have proper financial reporting, balance sheet, income statement, cash flow statement, and all your financial ducks in a row. You want to make sure that you've got everything in order. You want to have strong financial systems in place, whether that's, implementing QuickBooks, FreshBooks, any of the financial packages that are geared for software as a service. And then you want to have accurate financial models and forecasting. So from those financial systems, that begins the build of your financial models. That gives you your statistics that you can present to your potential lenders or equity raisers. And forecasting is imperative because, as James said, they're going to want to see from 1 to 3 to 5 to possibly even 10 years out. So how do you see your business looking during those periods of time? And then also on top of that, it's your financial ratios and especially your SaaS finance ratios, your MRR, your ARR, your churn rate, your burn rate, bookings, your sales rep ramp. So in order to really have that credibility with your lender, you need all that stuff in place. And that's the type of service that we also provide. James, back over to you.
Yeah, thank you. Yeah, I think one of the most important things that we focus on with our clients when we're running a transaction with them, and frankly, it's been getting more common that they don't quite have it in place. It's the systems and the proper experience at the helm. You do need that. A lot of lenders actually do require some type of financial leadership in their borrowers in order to close a transaction. So, whether you work with a group like us or some of the other groups out there, or you go to market independently, be prepared to get a lot of specific questions around your financial leadership, your systems. It's really important to have those buttoned up because the way a lender sees it, if you don't have these items in place, and they don't need to be full-time, they could be contract, they could be consulting, they could be transaction-oriented. But if you don't have that in place, they view that as a giant red flag, regardless of actually how the business is doing, because they want to make sure that things are moving along nicely. With respect to terms and structures for venture debt, as I'm sure you can imagine, the most common finance term, it depends. But I'd say in general, we tried to put together a profile that makes the most sense, given our typical client profile. So, today's rates, 10 to 13% on the interest rate range. Private credit funds in the venture debt space are up about 25% year over year from a rate perspective. Banks are up, 50% plus in some cases, just given the Fed rate increase over the past 12 to 15 months. So expect a slightly higher rate than you'd prefer. They are likely to potentially start coming down sometime next year, but I would anticipate these rates holding steady for the next 12 months or so. 3 to 5 year term, smaller deals tend to be on the 3-year side, with larger deals more on the 5-year side of things. 6 to 24 month interest only period. Yes, I know that is a very big range. A smaller $2 to $3 million transaction is likely, 6 to 9 month interest only period, where, call it a 5 to 15, maybe $20 million transaction tends to have a longer cash flow or interest only period, to benefit your cash flow as much as possible. You're going to have warrant coverage. The way it typically works, simple math. Now, this is not taking into account the companies with massive valuations or the companies that are looking for a small amount of cash with respect to the size of their business. This is kind of a standard across the profile deal. You're generally looking at dilution equal to less than 1% of the current cap table. Now, 9 times out of 10, the lender will take their dilution along with everyone else, but the warrants are there to, one, that helps with their overall economics, of course, but it does align everyone in making sure that the company does succeed. Lenders tend to be very, very favorable as far as practice with companies because, as a result, the company succeeds, they make more money from their warrants. Most of our deals, not like, a lot of the traditional venture lending profiles, they're not looking to do an equity round. They're looking specifically to avoid that. So most venture debt deals actually don't require the equity co-investment from existing shareholders or new investors. Yes, there are anomalies, but I'd say the vast majority, as in 95% plus of the transactions that we work with, have no equity co-investment coming in alongside the deal. And no personal guarantees, as I mentioned before, which everyone loves. It's underwritten on the business. How's the business doing? How are you growing? How's liquidity look? What's this business going to look like 6, 12, 18, 24 months from now? And that's how they're underwriting. I get this question a decent amount. Who are your lenders? Where do you guys find money to lend to a company that is losing money, that has no assets? We're a software business. Who's going to lend money to us when we're not cash flowing ridiculously? It's actually a pretty big market. Banks and non-bank providers alike, so private funds. Banks obviously are tightening quite a bit from a lending perspective. The big money banks started dipping into the venture lending. They frankly are pulling back quite a bit. Regional banks might have tried. They're really pulling back. So there really are very few tech lending banks out there. So most of the transactions right now are culminated through private funds. So they look at, they know the financials of growth stage companies. They look at tech companies and non-tech companies alike, but they underwrite, as I've said several times, on the growth of the business. Where is this business going to be as a result of me writing a check to this company? It's similar, again, to equity investing. They look at the long-term opportunity and return. Yes, they want to make sure that there's enough liquidity in there to make their payments each month. But at the same time, they're not looking back over the past 3 years to see if you have the positive cash flow to make a payment. They want to understand, hey, if I give you $3, $5, $10 million, how is that going to be put to work to grow the value of this business and continue growing that top line? So that's really how they look at everything. So two things to take into account when you're looking at the different types of credit providers. Generally, if banks are an option, we do like to run parallel processes with banks and private funds. What we find companies like and have challenges with respective terms are the banks. You're going to have a lower cost of capital. Yes, it is less of a spread than it was last year, but it's still a cheaper cost of capital than a private fund. As a result, you're going to have tighter terms. You're going to have tighter covenants, structures, maybe a little bit less cash availability. So they might tranche it a little bit differently based on performance milestones than someone like a private fund, who's going to charge a little bit more, but they have a higher risk tolerance. They might have little to even no covenants in a deal. If a bank might offer $5 million, a fund may offer $7 million plus. A bank might have a liquidity covenant of X. Fund might have no liquidity covenant or no covenant at all because they want to make sure that the company is able to operate as they see fit to continue growing the business. Honestly, we've seen a mix. Some companies just prefer the lower cost of capital and are willing to accept the terms. Some companies like the flexibility and are willing to pay for it. It really comes down to what the preference is from an individual company perspective. Something to be aware of what lenders want to see in today's market. This is very important because this is in almost every transaction. Cash management. You can burn cash. I want to make that clear. You can be cash burning, but it's not uncontrollable anymore. If you're generating $5 million a year in revenue, they don't want to see you burning $4, $5, $6, $7 million in the same year. It's not the market right now. Yes, having an immense amount of liquidity may flex that threshold a bit, but to be honest with you, companies want to know that if you need it, you can manage cash effectively. Loyal customers, that's pretty important. SaaS is obviously one of the big industries out there that focuses on revenue retention. Most companies, I will say, do have some type of recurrence or reoccurrence in their customer purchase patterns, whether they're product sales businesses, alternative technology businesses, services businesses. Usually B2B companies in particular have some type of frequency that their customers come back. They want to know how you manage that. How many times do you really need to sell your product or service? Is it every single dollar has to be sold every time? Or do you have repeat customers? Having those loyal customers, be able to show the data behind that is really important for lenders. And then unit economics. They don't want to see you spending, $50,000 to generate a $25,000 value customer. The math just isn't there. That lenders are really focusing on the economics of what is your return on investment for new customer acquisition, for marketing spend, especially if you're in the SMB or consumer space. They want to know that if you're spending, there's a good return there in this market. You're not throwing things at the wall. There's more of a rifle shot approach in that you know exactly what dollars are going where, and you know what type of return that is likely to generate. They want to know essentially your sales, your marketing, your business development. You know how to get in front of your customer at the right cost. So In summary, what's the market look like today? It's active for the most part. Everyone has adjusted their parameters a bit. I'd say, the bank lenders are really tightening up for the most part. Non-bank lenders are more active, as is typical. Non-bank lenders have a higher risk tolerance. But I'd say across the board for companies that are generally performing in their sector, not over leveraged as it is, not struggling to retain customers or manage cash, there are debt options out there. SVB, for example, as everyone knows, was the biggest player in venture lending. Yes, they are still around. Their model will likely be a bit different. So as a result, we are seeing more companies, in the market looking at different debt options. And, with what looks like a, continually flat equity raise market for the growth stage companies continuing through at least the end of the year, debt's becoming much more attractive to a lot of boards, a lot of managers looking to preserve their dilution, as long as possible. Perhaps looking at a return to the equity markets sometime in 2024. So that's all I have. I will, happy to open up for any questions.
Thank you, James and Adam. We got a couple during the presentation. If anyone has anything else, please feel free to add it in the chat. This one's from Arjun. He runs a SaaS company doing 6 million ARR, but haven't raised more than a friends and family round. Does this limit my debt options?
It does limit it, just in the sense that certain lenders do want to see that active sponsorship there still. But I'd say, similar to what I presented above, if the economics are sound, if the cash management strategies are there, especially for a software company, there are a good amount of options out there for companies that haven't gone the traditional venture capital route before.
This one's from Sam. My current lender is a bank, and they're telling me I may trip liquidity covenant later this year. What other options do I have?
So we're getting that a lot. Banks are trying to get out of a lot of their positions right now, and they're looking 6 to 9 months down the road. So it is good that they gave you that heads up that far in advance, because not all lenders give you that kind of courtesy. Typically, if a bank was willing to lend you money, there are non-bank options. It's likely going to be more expensive, but if you are at the point where you might be tripping a covenant, banks are, they're going to want to make sure that their capital is protected. So, it might make sense to start exploring some non-bank options sooner than later, just so you're properly prepared for that time.
Adam, this one would be for you. You mentioned you should have proper financial reporting and strong financial systems in place. Can you give some examples of what that might look like?
Yes. So definitely from a financial systems and packages standpoint, you would want to go with something that's well known in the industry, like a QuickBooks, FreshBooks, Xero, Sage. And then you want to have someone in place that stays on top of those systems and makes sure that it has the most updated information, so that all of your financial records are up to date and accurate.
Yeah, I will say running a transaction with out-of-date information, whether it's an older forecast, financials that are, actuals, but are 3 months old, it can create a lot of challenges during a transaction, because everyone wants to see the latest and greatest information.
And this is kind of an add-on to that question. Do I need a CFO on board in order to raise debt?
The short answer is not a full-time by any means. There are a lot of contract options out there. There are individuals, there are firms. What I will say is you need financial leadership. What that looks like is a company by company basis. You need someone who knows finance and not just took an accounting course, or not just can build an Excel forecast. You need someone who knows financial practices, systems, protocols. They've been there, done that, to at least advise. Lenders are getting more and more conscious about making sure that financial leadership is there. Some of the major companies that you read about last year that just fell apart, many of them had not, they had pretty poor financial practices in place or financial leadership. So, lenders are getting very conscious on making sure that the person making sure that cash is good, cash flow in and out is working, systems are there, lenders are making sure that that person knows what they're doing. So a CFO would be, the most likely option, but at the very least, you need financial leadership in there to make sure things are moving along.
And last question here. This is from Dave. My investors aren't providing any more capital, but I'm still burning cash. With investors not willing to invest more, will lenders be open to lending me money?
Most likely. Everyone likes to know what the investor sentiment is, of course. And yes, it's preferred that existing shareholders have more cash. However, we're seeing a lot of that right now where that additional cash was used up through the late 2022, early 23 with insider rounds and extensions. So provided that, the debt capital can get you to a solid point, whether it be a revenue threshold and or ideally, at least if you wanted to, a cash flow neutral position in, the next 6, 9, 12 months, whatever it might be. Generally there are debt options available for a company in that situation.
Perfect. Well, if no one has any last questions, that will do it for the webinar. James and Adam, thank you both for joining us today. If you would like a copy of the recording, please follow up with us. We have all this information so you can share it with your team or anyone else who may need it. But thanks again, guys, and we'll see you soon.